Okay, so when a giant bank like Goldman Sachs starts talking about an iconic brand like Porsche, people tend to listen. So let's dive into this and see what a small change in numbers can tell us about the much bigger picture.
It's a question that can feel pretty complicated, right? You see these headlines all the time about ratings and price targets, but what are they actually trying to tell you? Well, we're going to break it all down using this real-world example with Goldman Sachs and Porsche.
So here's the main event. It happened on February 25th, 2026. The two big names here are Goldman Sachs and Porsche Automobil Holding. Now here's a key detail. This isn't the car company itself. It's the holding company that has a massive stake in the Volkswagen Group, which, you guessed it, owns the Porsche car brand. All right, let's get into the numbers. Before this whole announcement, the Goldman analyst had their price target for Porsche set at 46 euros. You can just think of this as their old forecast for where they thought the stock price was headed. And then boom, came the change. The new price target was dropped to 40 euros. Now, on the surface, that's a €6 difference. But the story behind that number is what really matters here. And that €6 drop, that works out to a 13% cut in their forecast. See, it's not just that the number went down, it's how much it went down. A double-digit drop like this, that's what makes investors sit up and take notice. All right, so we've got the raw numbers, but what does all this analyst speak actually mean in plain English? This is where we get to the so what of it all, by decoding some of this language. So first up, we have this neutral rating, which, by the way, Goldman Sachs kept the same. Honestly, the easiest way to think about this is like a C+ on a report card. The analyst isn't saying the stock is an A+, but they're not saying it's failing either. It's just kind of there. No huge reason to rush out and buy it, but no reason to panic sell either. And a price target is pretty much exactly what it sounds like. It's basically the analyst's best guess, their prediction for where the stock's price is headed over the next year, maybe year and a half. It's a forecast, plain and simple. Okay, and this is where it gets really interesting. This is the real puzzle. If the grade is still neutral, that C+, then why on earth did they slash the price target by 13%? It feels a little contradictory, right? Well, this is where you got to read between the lines. And the answer is all about caution, not crisis. That's the key takeaway here. They're basically just tapping the brakes, not slamming on them. It's a subtle but really important distinction. So if you look at how their thinking shifted, it's pretty clear. The old view saw a good bit of room for the stock to grow, what analysts call upside. The new view, well, with that lower target, they're basically saying, hey, we don't see as much potential for gains from here as we used to. They've just reeled in their optimism a bit. So why pull back on the optimism? Well, it usually comes down to the fundamentals. We're talking things like maybe they've revised their earnings assumptions, or they've looked again at the valuation of Porsche's big stake in VW. Or maybe they're just seeing some broader economic pressures, headwinds that could hit the whole auto industry. And you know what? The report itself basically spells it out for us. This quote is perfect. The key phrase here is valuation reassessment. That's it right there. They're not saying Porsche is a worse company all of a sudden. They're just saying, hey, we've rerun the numbers, and based on our new math, we think its future value is a little lower than we did before. All right, let's bring this all home. This gets us to the big now what question. How do you take this signal from Wall Street and translate it into, well, anything meaningful? And really, the most important takeaway is this. A signal like this, keeping the neutral rating but lowering the price target, it's like seeing a yellow light, not a red light. It's a signal to slow down and pay attention, not to make a sudden big move. So what exactly should people be paying attention to? Well, the source points to a few key things. First, any news coming directly from the car maker, Porsche AG. How are their sales? How's production? Second, what about the parent company? Keep an eye on the Volkswagen Group's results. And third, watch what other analysts do. Are they also going to start changing their forecasts? These are the kinds of things that will show whether Goldman's caution was on the money or maybe a little premature. And all of this leaves us with a big, lingering question, doesn't it? This one note from one analyst is just a single piece of the puzzle. But is it a sign of just a temporary little slowdown for one company? Or is it maybe an early hint of some much bigger challenges on the horizon for the entire luxury car industry? That's the million-dollar question, and you can be sure that's what everyone is going to be watching.